But time to shift gears then, and it's five-star business. It has been a recent listing, and there's been nothing but pretty strong growth that we've seen. But is there threat now from rising competition? Will the asset quality trends remain intact? All of that will be answered by Srikanth Gopalakrishnan, who's the CFO of the company. Good to have you on board. And as I said at the start, it has been pretty strong growth for you so far. You've revised your guidance upward to 35%. So what kind of market opportunity do you believe can yet be tapped, and how do you plan to capture that?
Good morning to all, and thank you for having me on the show. The market opportunity for this segment continues to remain, extremely robust. And, one of the studies that we had given in the DRHP is that, the market opportunity for this is 22 trillion Indian rupees. And we operate predominantly in the tier 3 to tier 6 kind of towns, where, people don't have access to formal finance. These are small businesses, self-employed individuals who don't have documentary proofs of their incomes by which, they can go to the larger NBFCs or the banks to avail funding. So given that if we have the right kind of infrastructure to tap these people, because we believe, while, there are a lot of other NBFCs who are continuing to tap into this space, we believe the biggest competition for us comes from the unorganized sector or the money lenders, who are like, thousands and lakhs in our country. If we are able to displace them and give these borrowers, better interest rates, give these borrowers more organized finance, give them the opportunity to amortize the loan on a monthly basis through an EMI mechanism, give them good protection for the collateral that they give to us. And these are people who are going to graduate from money lenders to institutions like Five Star. So that presents a huge opportunity. Whether it's 22 trillion, 20 trillion, we can keep debating till the cows come home. But the opportunity in front of us is immense. And today, Five Star as an institution has built the infrastructure to actually go and tap into this segment. As we speak, we have more than 400 branches across 8-9 states of this country, predominantly in South. So once you have an infrastructure, you have the ability to reach out to these customers. You have the ability to underwrite these customers, underwrite their cash flows, and give the loan, and are able to have the right collections infrastructure to ensure that your asset quality stays robust. I would think the opportunity is extremely immense, and which is one of the important reasons that we revised our growth guidance from 30% to 35% in the recent past. So we are very confident of growing at that pace, given the opportunity and the strong infrastructure that the company has built.
But what kind of runway do you have from the existing capital, or would you need to raise more?
See, this is a very tricky question, I would say, especially if you have looked at our numbers. We are not even leveraged 2:1. Our debt equity is 1:1. So, and we have also been an extremely profitable company. We continue to, for example, last year we clocked a profit of 600 crores. We will continue to 600 plus. We will continue to keep improving on this profitability. So that's also going to get added to the net worth. So the intent today is not even to look at capital for the next few years, so which is very good from the shareholders' perspective. There are going to be no dilutions. The intent clearly is to increase the debt, which will definitely be benefit to the shareholders in the form of better return on equity. So we have a very long runway. Our debt equity is 1:1. We had a net worth of about 4,500 crores, which will continue to keep growing up. Now, let's say even if this number goes to 5,000 to 6,000 crores in the next 2 years or so, and looking at a leverage of a debt equity of about 3:1 from there, the maths is very clear for all of us. You're talking about 20 plus thousand crores that we can very easily grow with the kind of capital that we have.
There are a lot of P investors in your company. Some are selling, some are buying. Is that independently of what's happening in the business? I mean, you don't bother about what's happening there?
So, Nikunj, I would not be able to say that, we don't bother about what's happening there. Obviously, some of these things are going to have some bit of, murmurs in the market and all that. What we try and do is we ensure that, there is a coordinated effort on the part of the sellers to actually, offload their stake whenever they want liquidity. So obviously, I can't expect them to stay invested forever. But at the same time, investors have also seen the benefit of compounding over the last many years. The good part is these are not investors who have been invested with us for 12 months, 24 months. Like Matrix Partners came in 2014 and 15. So that's almost like close to a decade that they have stayed invested. Even the largest investor like TPG has been with us for now, I would say 6 years or so, 6, 7 years, 5, 6 years. So very clearly they understand that their actions are going to have some impact on the markets. And it is also important from their perspective to ensure that there is a good coordinated effort. And the whenever they have to offload their stake in the market, it is also important for them as well as the company to bring in the right set of investors. So obviously, there is a coordinated effort. We will try and do what we can to bring in the demand for the supply that they may have from the right set of investors. So you will see supplies coming through. Nothing that we are aware of to come in the near term. But yeah, you will see supplies coming through. But we are also very confident that we will get the right set of investors, like what we call as the long-only investors or the sovereign funds, to come and pick up these stakes. As long as
Right.
we are able to keep the
You will appreciate the spirit of my question because there's a large investor who's looking at unwinding their positions and they have a large investment in Five-Star, that's Sequoia. So my question perhaps was specific to that because when we speak to some market participants and folks who track your company, your stock, they said that that is a big overhang. So I just wanted to get your perspective on that.
So, Nikunj, exactly the point that I was making. It will be perceived as an overhang, but the comfort that we can give, especially, since you have taken the name of Sequoia, is also the fact that Sequoia is also one of the entities of Sequoia, which holds close to about 9% or so, has been tagged as a promoter in the IPO. So they have also locked in a portion of their shares. So that portion of the shares is locked in for 18 months, which is at least about roughly a year from now. So I don't think, the risk that the market perceives is as big as what they are perceiving. Obviously, like I said, there will be, supplies coming in at points of time. We are in constant touch with all the investors and, we will help them or we will facilitate a right kind of, I wouldn't call it as an exit, but right kind of a sell strategy for them, by which, they are able to optimize their returns and the company and the public shareholders also don't suffer. So the intent is to bring the right set of investors and, ensure that we have a match in demand and supply. See, beyond that, I think, if we are of the firm belief that these investors have been associated with us for a long time and they're not going to do anything that will be to the detriment of the company.
My next question is on your NIMs. They're fantastic and some would say they're enviable and everybody is keen to understand that how long can you sustain this kind of a spread as you grow? Because right now the book is small. When it will grow, can you sustain this kind of a spread?
So let me just break the question into two parts, Nikunj. One is the spread and one is the NIM. We have been guiding this, over the last about 3-4 quarters when we've been doing the investor calls and interacting with the media. Our steady state expectation on the spread is about 12 to 13%. See, today we are lending at around 24% or so. Our borrowing cost has sharply dropped despite what the market has seen, 250 basis points increase in the repo over the last about 12 to 15 months. We have actually seen just 50 basis points increase in our cost of funds. So our costlier borrowings have been replaced with cheaper borrowings, which means our spreads have actually gone up. The NIMs are inflated today because of the lower debt to equity. So today, while you see NIMs at around 17 to 18%, I would say these are not, I wouldn't use the word sustainable, but these are not realistic because this has an inflated capital base. Once the leverage starts increasing, we will surely, see the NIMs falling down to more like 14, 15%. So our guidance has always been that we will continue to hold the spreads at about 12 to 13%. Today, they are also a little bit inflated. I think the markets, interest rates in the markets are sort of getting to a point where we will be able to reasonably predict that it will either stay at the similar levels or it will probably start, dropping. Which means, we'll also pass on some of these benefits to our borrowers. So the spreads will drop, the NIMs will drop. But having said that, I think what the market or the shareholders will expect from us is while we are at about 16-17% ROE today, at an ROA of 8% and a leverage of 2x, if we are able to increase this leverage, let's say to about 3.5 to 4x, obviously there will be a constriction in the ROA, which will probably drop to about 6.5 in the steady state scenario. But that essentially means you're looking at a north of 20% ROE, which is extremely attractive for the investors. So that's the journey that the company is embarking on to create, very good wealth and a long-term value for the shareholders.
Okay. Aditya, great to have you on the show today. Srikanth, I beg your pardon. Good speaking with you as always.